Hello everyone, this is Abhay Agarwal from Piper Serica. Happy to share our views on the last month, which is October 2025, for our public market investors in all our public market funds. The last month was pretty positive overall for the Indian stock markets, in line with the international stock markets. The revival in the Indian stock market, which was reflected in a 4.5% increase in the Nifty index, which is a large cap index, was largely because of two factors. One, there was an oversold situation. The markets were in a rough shape in the prior month. So some bit of it was just a relief rally, catch up rally. And secondly, there was a big expectation that India will soon sign uh, a tariff deal, a trade deal with the US, and which will lead to the penal tariffs of 25% going away, and also the regular tariffs of 25% being brought down to 12 to 13%. However, none of that happened, and it is not surprisingly we were not banking on it, because a lot of factors play out before these trade deals are signed, especially the sensitive ones that involve India and the US. So that is still work in process. In that situation, our public market funds returned about 2.6% last month, significantly better than the small and mid cap funds, which returned on an average around 1% to 1.5%. In the longer term, we continue to track our alpha of 4% over 5-year cycles. Absolute return for 5-year cycles continues to be 18% on an average, which is the zone that we want to be, and we're very confident that we'll continue to deliver on that over 5-year cycles. In terms of portfolio changes, you would have noticed that we have exited our position in Zee. Zee has been a classic case study of how, despite all the research in the world, despite you as a fund manager meeting all the checkpoints, you still go wrong. So we thought for a long time that Zee as a company is a leader, which it is, in the Indian television industry, media industry. It is the largest player in the television industry, cable TV industry, profitable. It has this OTT setup called Z5, which is doing well. So it has everything going for it on the business side, and trading at a valuation multiple of about 10 times, a growth company we thought was a good value buy, but it frankly turned out to be a value trap. We pretty much exited after taking a 20% haircut, after realizing that one of the bets that we were making were not playing out in the way it should, which is that the promoters will change, and the same promoters that got the company into trouble continue to run the company despite a low single digit shareholding, because of the simple reason that the institutional investors that own majority of the stock somehow do not have the spine to change them. So we are quite disappointed that a stock that we thought would do well re-rate hasn't re-rated. We do not want to continue to wait, because we do not see the current management team being removed or changed. So if nothing changes, we don't see how the stock will re-rate. So as a result, and also because of the reason that we have found better opportunities to deploy our capital, we exited Zee. We used that money for two things. One, we added to our position in Sonorous Pharma, which we discussed last time, which is a small cap pharmaceutical company with a strong presence already getting created in the US. And we are happy to share that the stock hit an all-time high today. The results were outstanding, and we believe that this is a multi-bagger story playing out. The second stock that we have added, that you would see in your current month statement, not in the last month statement, is a company called Inox Industries. Inox is an old player in industrial gases. This company of the group listed year or so back, and this is the largest player in India of cryogenic tanks. So any industry that needs fuel to be frozen or oxygen to be frozen below 150 degrees, so minus 150 degrees to minus 300 degrees, you need specialized tanks to not only store but also to carry over long distances. And Inox has been the leader for many years in that. It has almost 60 to 70% of Indian market share. It is also an exporter to SpaceX, So that tells you about the quality of the product. The big bet here is that just like China did, India will also encourage long distance travel of trucks and buses using LNG as a fuel rather than diesel, which will reduce cost by 30% and also is more environment friendly. So while China has 10 lakh trucks that use LNG as a fuel, India has 5,000. So that gap will get covered, and each of these vehicles needs a 4 lakh rupees worth of tank which carries this LNG in the frozen form, and that is where Inox industry comes into play. It is also got into very through its science vertical into semiconductor gas storage, and it also is the exclusive supplier for ISRO for storing the rocket fuel for its rocket launches. So the company is very advanced on technology, has a great market presence, and we believe that we're picking up at a time when it is getting on a growth curve, and that growth curve should deliver an average growth of 15 to 30% over the next 3 to 5 years. So we are quite hopeful that a company which has a market cap of about 11,000 crores can become a multi-bagger over the same period and deliver good returns for our portfolio. Other than that, the results season that we are in the middle of right now in India, results have generally been better than expected. There are a few disappointments, but I would say if there are 10 companies that have announced their results, I think 3 have done much better than expected, 1 has underperformed, and rest have been as expected. So I think we are getting into a phase where the earnings recovery in India is clearly visible, driven not only by domestic consumption but also by exports. So I think barring the blips because of geopolitical reasons, because of rebalances in the portfolios close to the end of the financial year, we are in November. I think another month or so before portfolios rebalance for global FPIs, and the FPI sell-off abating. I think these are the things that are going to keep the market on tender hooks for next couple of months. That is our expectation. So we expect bouts of volatility, just like we are seeing right now, a global market kind of sell-off, then recovery, then another sell-off. Will continue to play out. It's not going to be an easy route for next 2 months. The good news is that there are enough opportunities for long-term investors to invest in high growth companies in India. These companies are not cheap by traditional metrics. They trade anywhere from 30 to 50 times P multiple. But once you start building growth into that valuation metric and you look at the PEG, these are still at about 1.5 time PEG, which is not bad. That's where we have historically seen multi-bagger returns being made. So that is a space that we will continue to focus, and whatever is not working, wherever we believe that companies where growth is slowing down, we will exit those companies and we will redeploy those funds into companies that are firing on growth engine. So thank you very much for your time, and we would be back with you next month, same time.